Hello everyone, I am Prapti Kanakya and welcome back to Familiar with FEMA series by Vinod Kothari and Company. In this video, we will be understanding what is foreign portfolio investor and what are the investment avenues available to foreign portfolio investors. So let's begin to understand what is foreign portfolio investor. We all have the idea of institutional investors. Institutional investors pool money from various investors, that is retail investors, corporate houses, etc., and invest in the securities. And if such institutional investors are set up in foreign jurisdiction and are wanting to invest in Indian securities market, then they need to obtain the registration of a foreign portfolio investor from SEBI. So foreign portfolio investors are basically representing foreign funds and therefore they need to comply with the FEMA provisions. And since they will be investing in the Indian securities market, they will need to comply with the SEBI regulations. Let me just share my screen. So as discussed, FPIs, for that is foreign portfolio investors, will be required to comply with the FEMA norms, that is FEMA Non-Debt Instrument Rules 2019, which deals with the investment in the equity instruments of an Indian company. Then FEMA Debt Instrument Regulations 2019, which states the investment avenues for an FPI in the debt instruments. And from the SEBI perspective, FPIs will need to comply with the SEBI Foreign Portfolio Investors Regulation 2019, which provides the eligibility criteria for registering as an FPI. In which categories can an FPI register themselves? What are the ongoing compliances that an FPI will need to comply with? And with whom should the FPIs get registered? Then there is a master circular by SEBI on FPIs, TDPs, and eligible foreign investors, in which the operational aspects of the SEBI regulations are provided for FPIs. So, FPIs, which fulfill the registration or the eligibility criteria as provided in the SEBI FPI regulations under Regulation 4, can register as a FPI with designated depository participant. DDP, which is also, they are also called as DDP. So DDP are the depository participant which are registered with SEBI for providing the registration and other ongoing compliances to FPI. So the FPIs which fulfill these criteria can be registered as either category 1 or a category 2 FPI. Category 1 FPI usually comprises of government related investors, institutional investors, endowment funds, etc. Whereas category 2 investors comprises mainly of those investors who cannot be registered as a Cat 1 FPIs and also includes individuals, corporate houses, charitable funds, etc. Now, let us understand where can the FPIs invest. So basically, we can classify the kinds of securities into three broad parts: equity instruments, then debt instruments, and hybrid instruments. So SEBI FPI regulations and FEMA debt instrument regulation provides the investment avenues for FPIs. So if we consider from equity perspective, shares and warrants of a listed entity, FPIs can invest in these instruments. Then non-convertible or debt instruments, which includes debt of a listed company. Then other debt instruments which are permitted by RBI. And these instruments include government securities, treasury bills. Just a second. Government securities, treasury bills, NCDs which are issued by Indian company, commercial papers, units of mutual funds or ETF which invest less than 50% in equity, that is majority of the portion is in debt. Then security receipts, debt instruments which can be included in the regulatory capital of banks, credit enhancement bonds, listed non-convertible or redeemable preference shares or debentures which are issued pursuant to amalgamation or merger of an Indian company to FPIs. Then securitized debt instruments, rupee denominated bonds which are issued by infrastructure debt funds and municipal bonds. So these can be categorized as debt instruments wherein FPIs are allowed to invest. And rest of the hybrid categories like units of mutual funds, collective investment schemes, REIT, InvIT, Category 3 AIFs, and instruments like derivatives and Indian depository receipts are also the securities where FPIs can invest. Now, let's understand in detail the other conditions for investing in equity and debt instruments. So when an FPI is investing in equity instruments, they will be required to comply with FEMA non-debt instrument rules 2019, that is NDI rules. In NDI rules, there is a concept called foreign portfolio investment. So NDI rules define foreign portfolio investment as any investment made by a person resident outside India through equity instruments where such investments is less than 10% of the post-issue paid-up share capital on a fully diluted basis of a listed Indian company, or less than 10% of paid-up value of each series of equity instruments of a listed Indian company. That means if any person resident outside India is investing less than 10% in any equity instruments of a listed company will be termed as foreign portfolio investment. Here, the NDI rules is not defining foreign portfolio investment as investments made by foreign portfolio investor. And therefore, the term of foreign portfolio investor and foreign portfolio investment is different under NDI norms. Schedule 2, read with Chapter 4 of NDI rules, provides the conditions and criteria for investing in the equity instruments by a FPI. So under this chapter and Schedule 2, the FPIs can purchase or sell any equity instruments of Indian company. Here, equity instrument means equity shares, convertible debentures or preference shares, and share warrants issued by Indian company. So basically, any security which will be converted into equity falls under equity instruments. FPIs, there is an investment limit for FPIs under the NDI rules. So one FPI can invest less than 10% in the equity instruments of a listed Indian company. However, if there are more than one FPIs who are wanting to invest in the equity instruments of listed Indian company, the maximum limit that is allowed to them is the sector cap that is applicable for that particular company. So let's say, for example, to one entity which is listed on the stock exchange, the investment limit for foreign investors in that entity or the sectoral cap is 74%. In that case, if there are 10 FPIs who are wanting to invest in that entity, the maximum investment of all the 10 FPIs combined should not exceed 74%. Now, there might be cases where either the individual or the aggregate limit might get breached. That is, FPIs might invest more 10% or more than 10% in the equity instruments of a listed Indian company. In that case, the custodian is the person who keeps a track on the investments made by FPIs, either in equity instruments or debt instruments. So they inform the FPIs about their excess investment, and FPIs are given a time period of 5 trading days to divest their excess investment. If they don't divest these investments, then the investment will be termed as foreign direct investment, and therefore they will be required to comply with the FDI norms for these investments. There is also one concept of investor group under FEMA regulations and SEBI FPI regulations, wherein investor group is determined basis common ownership or common control. So if the FPIs are having common ownership of more than 50% or there is common control, they will be identified as FPIs falling under common or same investor group. So for this purpose, the investment limit will be identified basis investor group. Let's say, for example, there are 4 FPIs which are falling under same investor group. So if these FPIs are wanting to invest in one particular company, the total investments by all these 4 FPIs should be less than 10%. Here, the investment limit will get clubbed for 4 FPIs rather than individual limit. That means if 4 FPIs were not related to each other, in that case, all these investors would be having a maximum investment limit of less than 10%. But however, since they are falling under same investor group, their investment limits gets combined, and therefore all 4 can invest up to, that is, less than 10% in that particular company. Now, another criteria that is mentioned in the NDI rules is relating to pricing. At what price should the instruments be issued to the FPIs? So, if the company is coming up with a public issue for equity instruments, the price at which instruments are issued to FPI should not be less than the price at which the equity instruments are issued to an Indian resident. And in case of private placement, the company will be required to comply with the SEBI guidelines relating to pricing, or the pricing should be as per the internationally accepted valuation method certified by a merchant banker or a chartered accountant. And as discussed, the custodians will be keeping a track and reporting the transactions by FPIs on a daily basis to the depositories, that is, depository participants, DDPs, and the SEBI. Now, let's understand the methods of investment in debt instruments. The investments in debt instrument is managed by RBI. In this case, there are two methods or two routes that is available to FPIs for investing in debt instruments. One is medium-term framework, and the other is voluntary retention route. So, medium-term framework was brought in by RBI via bi-monthly monetary policy statement for the financial year 2015-16. In the medium term framework, there are certain conditions given through which FPIs can invest in the debt instruments. Under medium term framework, the instruments are classified into government security, including treasury bills, then state development loans, and corporate bond. Here, there is the one condition of concentration limit. That is how much maximum FPIs can invest in one particular category, that is government securities, state development loan, and corporate bond. Long-term FPIs, which include sovereign wealth funds, multilateral agencies, endowment funds, insurance funds, pension funds, and foreign central banks, can invest maximum of 15% of prevailing investment limit for that category. And for other FPIs, the limit is 10%. Now, if the FPIs are investing in any issuance by any Indian company for corporate debt, in that case, the maximum that they can invest in that particular issue is 50%. That means they cannot subscribe 100% of that issuance. The maximum limit allowed is 50%. And here also, the investment will be considered on an investor group basis and not on individual basis. Further, there was a requirement of minimum residual maturity. That means the minimum tenure that FPIs will require to be stay invested in these securities. Erstwhile, it was 3 years, but now the requirement has been done away with. There is one requirement in case of short-term investments, that is instruments which are having maturity up to 1 year. In that case, the investment should not exceed 30% of the total investments of that FPI in that particular category. So these are the terms and conditions for medium-term framework. Now we'll discuss about voluntary retention route. This route was introduced by RBI on March 1st, 2019, with the objective of attracting long-term and stable FPI investments and providing more operational flexibility to FPIs to manage their investment. So, erstwhile, there was only medium-term framework available. Post 2019, VRR is also one of the routes available for investment. Under medium-term framework, a maximum cap is provided or a maximum limit for investment is provided for FPI. That means under GSEC, the FPIs can invest maximum up to certain investment amount. Here, investment limit is in addition to the general investment limit. That is, under VRR framework, the FPIs have additional investment amount of 2,50,000 crores to invest in the debt instruments. And this 2,50,000 additional investment limit is divided into VRR government, VRR corp, and VRR combined. VRR government includes government-related securities like government-dated securities, treasury bills, and state development loans. VRR Corp includes instruments which are listed under Schedule 1 of the Debt Instrument Regulations, the one we saw above in the previous slides. But it does not include government related securities, as the same is covered under VRR government. And it also does not include the mutual fund units which are investing less than or equal to 50% in equity. However, if the mutual fund is investing only in debt instruments, that is 100% is in debt, those mutual fund units or ETF units will be covered under VRR Corp. And VRR combined is the combined limit for VRR. That VRR combined includes instruments under VRR government as well as VRR Corp. Now, let's look at the other investment restrictions or the conditions for making investments under VRR. So here there is a minimum retention period which is done away under medium-term framework. Here the minimum retention period is 3 years. That means if FPIs are committing any amount that they will be investing certain amount under VRR, then that means they should remain invested for a minimum period of 3 years in that instrument. At the end of that 3 years, the FPIs have the option of either liquidating their portfolio and taking an exit, or they can shift their investment to a general investment limit if there is available portion in the medium term framework. Or either they can hold their investment till maturity, or maybe they can sell it to another investor. Here, one additional flexibility is given to FPIs is that if in the middle of these 3 years they are wanting to take an exit, then they can sell this investment to another FPI who will hold the investments for the rest of the tenure under VRR framework. Further, FPIs can also transfer their existing investments in the general investment limit to VRR scheme. However, here there are two exemptions that are provided to FPIs, and that is relating to concentration limit and the single or group investor wise limit. The 15% and 10% concentration limit that we had discussed under medium term framework is exempt under VRR route. And the group investor limit, that is the maximum the FPIs are allowed to subscribe in one single corporate debt issuance, is 50%. However, under VRR route, they can subscribe to more than 50%. That is, one single FPI can subscribe 100% of the issuance of any company under the VRR route. So this are the two available routes in under debt instruments for FPIs through by RBI. So this is all about investments by FPIs and the avenues available and the routes available for investing in these securities. In case of any queries, you may post the same in the comment section below, and you may refer our further resources on FPIs on our website, that is prodkothari.com. Thank you.